Hello, I'm Chris Mercer, and I'm at Mercer Capital's worldwide headquarters here in Memphis, Tennessee. Today's valuation lesson is called Avoiding Valuation Problems with Life Insurance Associated with Buy-Sell Agreements. I wrote a book called Buy-Sell Agreements for Closely Held and Family Business Owners some time ago. In that book, I talk about the defining elements necessary to craft a good valuation pursuant to a buy-sell agreement. One of those defining elements is the standard of value, like fair market value, which should be the standard of value in virtually all buy-sell agreements. Another deals with the valuation aspects of life insurance, and that's the treatment that we're talking about today. Life insurance, from a valuation perspective, can be treated one of two ways. One is a funding vehicle, where the life insurance is used to offset the liability of repurchasing stock from a deceased owner and has little effect on the company. And the other is as a corporate asset, where the value of the life insurance is added to the value of the company, and then that value becomes part of the value of the deceased owner's shares. Simple example, two shareholders, 50% each, in a company valued at $10 million. There's life insurance on the lives of each owner for $5 million. When life insurance is a funding vehicle, let's assume one owner dies. Proceeds of $5 million come to the company. The deceased owner's shares are worth $5 million, half of the $10 million. The $5 million is used to offset that, so the remaining shareholder has no shares and no value remaining in the company but $5 million in cash. The remaining shareholder, on the other hand, has 100% of the stock and a company worth $10 million. In the second treatment, life insurance is treated as a corporate asset. So an owner dies in the same fact pattern. The $5 million comes to the company. It's added to value, so the value of the company with the life insurance is $15 million. Half of that is $7.5 million for the deceased owner's shares. So how does the company pay for it? The company writes a check for $5 million for the life insurance proceeds and then has to issue a promissory note. Now that's a topic for another valuation lesson, but issues a promissory note for the difference. What's the result? The selling shareholder, the estate, has no stock and no value in the company and $7.5 million in cash and notes, and the remaining shareholder has 100% of the stock and a company worth $7.5 million. Now let me ask you this. If you were the remaining shareholder, would you rather have a company worth $7.5 million as with a corporate asset or $10 million as with a funding vehicle? Let me ask another question. If you were the estate of the deceased shareholder, would you rather receive $5 million for the stock that your husband owned or wife owned, or would you rather receive $7.5 million? Those are really questions that are obvious, but you would rather have the one that benefits you most. Know this, when an owner in a company dies, the interests of the estate and the remaining shareholder or shareholders diverge, and their divergent interests create tension and the potential for disruption and disagreement and even litigation. So let's look at an actual buy-sell agreement draft that I was asked to look at in connection with a current valuation project. And I'll just read the portion applicable to the life insurance. Upon the death of a shareholder, and I'm reading now, and see if you see the problem based on what we've said so far. The company shall pay to such holder by certified or bank check or wire transfer of immediately available federal funds the amount of the proceeds of a life policy up to the amount of the put price per share for the put securities being purchased by the company. And if the proceeds of the life policy are insufficient to pay the entire put price per share for all such put securities being purchased, the company shall issue to such holder an unsecured promissory note, ... Now, I've sort of given it away, but That's the entire treatment of life insurance in this buy-sell agreement. So you see the problem. There's no discussion of how the appraiser, who's going to determine the put value for purposes of this agreement, that is the fair market value of the stock, no instruction for how to treat it. So my suggestion, I sent language for the company and their counsel to consider and see if you see now that language like this would solve the problem. Considerations of life insurance proceeds in the appraisals. The corporation owns life insurance policies on the lives of its shareholders. This is an acknowledgement in the buy-sell agreement that the policies exist. The purpose of the policies and proceeds, if any, is to provide a funding vehicle for the corporation separate from the operating assets of the corporation to repurchase shares of a deceased shareholder. Now that is very, very clear. It goes on. By agreement of the parties, the appraiser is instructed that any life insurance proceeds received by the corporation upon the death of a shareholder are not to be considered as a corporate asset in the determination of fair market value and purchase price in any appraisal. Now, I sent that language because after talking with management, it was clear that they intended for the life insurance to be a funding vehicle. So in conclusion, how can you avoid valuation problems with life insurance associated with buy-sell agreements? Well, number one, you get the parties to agree on the treatment that the appraiser is going to use. And they agree upon it and they reflect that agreement in the valuation. You reach agreement now so that you don't have massive disagreement and maybe litigation later. So that's the valuation lesson for today in avoiding valuation-related problems with life insurance associated with buy-sell agreements.